Hello, this is Michael May of Royal Shell Real Estate. I'm a broker associate with Royal Shell as well as a past mortgage broker and mortgage brokerage business since 1991. I know about financing of homes. I want to talk to you today from my office here on 5th Avenue in Naples, Florida. It's a lovely, lovely Saturday afternoon here. Temperature is in the mid-70s. The subject today is what I want to discuss will be the subject of what I call to be the falling glass ceiling. When I mention glass ceilings, what I'm referring to, as we all know, is where you see something above the ceiling but you can't attain it. In the case of buying a home here, we're actually seeing that glass ceiling declining. The definition of a glass ceiling in the case of real estate is what someone is either willing to pay in the case of a cash deal or are able to pay in the case of a mortgage. Now my calculator here tells me that with rising interest rates and increase in prices, both types of buyers will be affected. A person that wants to pay cash may not like what's happening and may have in themselves a ceiling of how much they can afford to pay even though it's cash. So as that ceiling becomes more mobile and starts to reduce in its height, the properties that were originally below the glass ceiling that they could attain are actually now, because of price increases, are now going above the glass ceiling. In the case of someone who is getting a mortgage, that is their ability to pay for a certain amount of mortgage based on their debt to income ratios. And my calculations show that for every quarter point increase in interest rate, the payment goes up about 3%. So if you have a half a point in interest rate increase, the payment's going to go up by 6%. That means that unless someone's income to qualify for a mortgage can keep pace with that rate of increase, they may have been approved on a property before that they cannot be approved on the same property in the future, because that property is going to be higher in price and they probably have a set amount of money that they can work with. So if they're buying, for example, a $200,000 home and they're getting an 80% mortgage, then that means they're getting a $160,000 mortgage. They have to come up with $40,000. But what happens if interest rates go up? For the same home, they're going to have to come up with more money in order to qualify for that loan based on calculations of their debt to income ratios. If they don't have the means to pay cash, there's a possibility that they have limits on how much they can put down. Therefore, even if the price of the home stays the same, they may not qualify and end up not buying a home. If you have both of those forces converging, an increase in interest rate and an increase in prices, that amplifies the problem for a non-cash buyer. And that person may literally walk away and be disappointed. As it stands right now, what I would recommend to someone in the interim to purchase, that instead of going with a 30-year fixed, that they may consider getting a 10-year fixed on a 30-year AM or a 30-year amortization, a 7-year or a 5-year or 3-year fixed on a 30-year amortization. Since those products convert after 3, 5, 7, or 10 years, the initial interest rates for those periods typically are up to a point lower than a standard 30-year fixed mortgage. And of course, if someone's very tight on their money and on their qualifying ratios, I would never recommend a 15-year fixed. A 15-year fix is good because it will save you a lot of money on interest, and if someone can afford a payment on 15, I would recommend it. But the fact is that a 15-year payment is 24% higher than a 30-year fixed. So if I had a choice between a 30 and a 15 and I know the person doesn't qualify for 15, I would say go with a 30-year fixed and then accelerate your payments to simulate what a 15-year fixed mortgage would do for you. that's a way to get around that. But getting back to talking about this glass ceiling. This glass ceiling is continuing to decline, and properties that 6 or 8 months ago were attainable for a cash buyer or for a mortgage buyer are either rising in price higher than what a cash buyer would be willing to pay, or are rising in price and with interest rates inevitably going to start increasing, shrinking a mortgage buyer's buying power. That glass ceiling is continuing to decline. I hope this has been helpful to you. I'll be happy to explain it to you in detail and use my old trusty HP right here to show you how that all works. This is Michael May signing off. You're welcome to give me a call at any time. You can reach me at 239-949-0000. And please do subscribe to my YouTube channel. Have a good day. Thank you very much. Bye-bye.